Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the eighth of the podcast, focusing exclusively on the markets, and this series is coming to you regularly every month. Bringing insights from experts on the subject is your host, Parvatha Vardhini. I am the editor of BL Portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Ashish Shanker, MD and CEO, Motilal Oswal Private Wealth. Ashish is an alumni of Harvard Business School and has worked in the asset management industry for over 6 years and in the private wealth management industry for 18 years. His roles in these two industries have spanned across sales, investment advisory, research, and products. Hi, Ashish. Welcome to the podcast.
Yeah, hi Vardhini. Good to speak to you today.
Great, sir. So, a very interesting time. 3 months have gone by, and although markets have touched new highs, it seems to be a little less sure of itself. So, what are the headwinds and tailwinds that you see at this juncture?
Look, to analyze the current period, you have to look at the context as to how the last 3-4 years have panned out. Because now, when you look back, COVID was the bottom. And from then on, our markets have rallied relentlessly, except maybe for a brief period between 21 and 22. So equity markets have done extremely well over these 3-4 years. So what has triggered this rally is robust corporate earnings, reforms across many sectors, which are now contributing to growth. And we've also seen that India has stood out in the global context, because growth has been a challenge across many countries. But within this environment, India has really come out shining. So these are few of the contributors to this extended rally that we have seen. One remarkable thing is the rally in the small and mid-cap stocks. I mean, you've seen many stocks actually going up 3x, 4x, 5x. Certain sectors, you've seen stocks go up even 8 to 10x. So it's been a great 3-4 years for markets, for investors, and for companies across varied sectors. So what's ahead of us? What we are seeing is a lot of the one-off gains in corporate profits are behind us. So just to give you a small example, going into COVID, we had a lot of NPAs on bank balance sheets which were written off. Right? You had huge NPA challenges in PSU banks which had corporate exposure. A lot of those banks have actually not just cleaned up their balance sheet, but they've also recovered some part of the NPAs. So you've seen a sharp growth in profitability across banks, which was a challenge in the previous decade. So that has obviously contributed to corporate earnings growing very fast. Now, there are many sectors like these where the corporate earnings were very, very poor and balance sheets were challenged. All those sectors have seen corporate profit growth. So to name a few sectors, auto in the recent times has again revived. Similarly, capex sectors or companies in the manufacturing sector, they had a lost decade between 2010 and 20. Now, with the government's focus on building infrastructure and giving more allocation to capital expenditure, you've seen companies in the defense sector, in the road sector, in the power sector, similarly railways, and you're also at the margin seeing private capex picking up, because many corporates are right now running at reasonable capacity utilization levels. So all of this has contributed to the strong profit growth, right? So this rally in the last 3-4 years is not without fundamentals. I think fundamentals and more than kept pace. And the earnings growth in the small and mid cap segment has been much higher than large caps. That's the reason small and mid caps have done extremely well. And in fact, they are now valued more richly than the larger cap counterparts because of the earnings growth, right? Having said this, if you look at the year ahead, right, India looks very good because fundamentals are good, growth rates are strong, and very likely that the same establishment comes back to power post-elections. However, having said that, world is not in that good a place. I mean, if you look at what's happening in Europe, what's happening in UK, US seems to be standing out a bit. I mean, their growth seems to be a little more resilient than other geographies. But at the same time, most of them are not at the prime of their growth. They're still struggling, right? And at the same time, if you see interest rates, right, they've not come off as fast as what the expectation was previous year. And that's because inflation has also been a bit sticky. Okay. So world is not as happy a place as India from a growth point of view. Secondly, this is a very heavy year as far as elections is concerned, right? India, of course, is heading into a general election and many more state elections after that. But if you look at globally, I mean, you have the US election, but many countries are going into elections, right? And geopolitics, is simmering. It's on and off. You had the Ukraine situation, then you had the Israel situation, and, the China, Taiwan is always hot and cold, right? So you have enough risks in the system. So I think whilst we continue to be bullish on India and we believe that companies will continue to do well, I think earnings growth will start trending to long-term averages now. So if you've seen like mid and small cap segment earnings growth of 30-35%, and large cap you've seen closer to 20%, 18-20%, I think it'll trend down from here on. So expectations have to be tempered. That is the crux of what I'm messaging to clients and investors.
Okay, sir. You did bring up this topic of mid and small caps, but you did say that, earnings growth has been much higher. But then, the regulator has been talking about froth in this space, and mutual funds are asked to do stress tests. So, how are the PMSs and the AIFs approaching this segment? And do you still see very good opportunities in this space?
So from a medium to longer term point of view, we still see a lot of opportunities for the simple point that see what's happening, Vardhini, is that a lot of the sectors which have been doing well actually belong in the mid and small cap space. It is actually very simple to categorize stocks in the mid and small cap category. But once you dig deeper, you realize the reason for these stocks to do well. The reason for these stocks to do well is because a lot of the sectors which are actually in focus right now, they are mid to small size companies. So we continue to be constructive, but it's just that markets will start now distinguishing between high quality and maybe not so good quality companies. See, in the first breeze, what happens is everything flies, right? Whether it is good, bad, ugly, everything flies. But now on, I think markets will start because see, valuation is now, I would say, from a very low valuation, maybe 3-4 years back. Mid and small cap stocks are now valued well, right? They're no longer cheap. So from here on, what is the additional trigger to drive stock prices? It has to be incremental profitability. Now, incremental profit growth may not be as strong as what we've seen in the last 2-3 years, but it'll still be better than longer term averages. So what will happen is markets will distinguish between good and bad quality companies. And second, returns will be more moderate and possibly more back-ended now.
So, in terms of how, I mean, the HNI areas of investment, the PMSs and the AIFs, so their attitude towards mid and small caps still remain positive, and investors are also happy with these funds taking more risks. They are not worried like the mutual funds. Is that how the line of thought is?
I think PMS and AIFs are in a very good position to invest in this segment, particularly because most of them run a little more concentration in their portfolios, and they can now, hopefully the market will distinguish and reward good stock picking, right? Because last 3 years has been more like a beta rally. If you see an index, actually I don't know if people have noticed, last 2 to 3 years, especially last year, the small and mid cap indices have actually done better than active managers. So it's been a beta rally in the sense that, liquidity has ensured that all stocks do well. And these guys have actually struggled to beat the index, some of these funds. So I think going forward, hopefully that changes in this category where stock picking gets rewarded. That is what I see. As far as your question on stress test, I think SEBI has been a fantastic regulator. I mean, if I compare SEBI to all the global regulators, they've been really proactive and vigilant. So I think what their messaging and whatever steps they're taking is very good. It will ensure that the markets, are more stable and, this rally will last longer. And it is important to remind people of the risks. So normally wealth managers do it, but we have a regulator who's also very vigilant, and we are happy that the regulator is also helping us ensure that the investors are warned on the risks.
So you did speak about earnings growth reverting to mean. So now, what was your estimate, say, in the beginning of this year on January 1st, 24? What was your earnings estimate for the year 24 or even FY25? And has it changed now?
No, in fact, at the margin, it's gotten better. I think we are expecting a 14-15% kind of earnings growth. Actually, we are expecting about 17 to 18% next year also. That is FY25. But I think I will be very happy if you get mid-teens.
Okay. So there's a little bit of a downward revision, but nothing much to really.
No downward revision, actually. It's just that, you can't grow at the same pace.
Right.
After this kind of run. Over the last 3 years, right?
And what would you call as the mean growth for large caps versus mid and small caps, and over how many years is the mean?
So if you look at the large caps, the earnings growth has been about 15-16% for the longest. But it's just that it's been a little lumpy. Like between 2010 to 20, the earnings growth was in single digits. Okay. Last 4 years after COVID, we've seen that it's been in the high double digits, right? So the longer term mean is about 15-16%. And I think you will revert to that number from this year onwards. But mid and small caps can still continue to grow between 20-25%. But they're all priced in for that kind of growth. Okay. So wherever there are disappointments, you'll see corrections.
Okay.
So that's why I'm saying that, becoming a little more discerning on what companies you want to hold. It becomes very, very important in that space. And if by any reason, because the stocks have done well, your portfolios got skewed towards small and medium-sized companies, then maybe you could rebalance it back to, the larger counterparts, or for that matter, if you're investing through funds, which is what most of our investors do, then, we are preferring flexi-cap funds going forward, where the fund manager has the ability to straddle market caps.
Okay. And when you spoke of, annual, this year's earnings growth, it was for the Nifty, isn't it? Which you're saying from 18%, you're expecting about 15-16%.
That's correct.
Okay, sir. Okay. And so you do have this 4C management framework, which I did get a chance to go through in a presentation. So now, it rates fund managers, isn't it? And then makes a choice based on how the funds are managed. And
yes, absolutely.
What is it indicating to you right now? So how do you apply the model?
Look, just to give you a quick rundown on the model, and I'll spend less time as you've anyway read about it. This is more for the benefit of your listeners. See, the 4C framework basically tries to capture all the components that you should be looking for in fund managers, right? So the first one being clarity of philosophy. What is the philosophy of the fund manager? How does he select his stocks, his or her stocks? Now, to keep it very simple, there are two extreme approaches. One, what I call mean reversion, which means you're a contrarian. To look for stocks which are out of favor, businesses which are out of favor, and you believe that, valuations are extremely cheap and there is a possible turnaround around the corner. Right. So that is one style of investing. So there are a lot of fund managers who apply this style of investing. Then on the other extreme, you have people who follow momentum. When I say momentum in corporate earnings. So wherever companies are in a sweet spot and doing extremely well from an earnings growth point of view, the managers tend to pick companies in those sectors or those kind of stocks, right? So these are at the extremes. Then you have fund managers somewhere in between. You have value, you have growth, and you have a blend style. Okay. But once you understand the two extremes, then you'll be able to understand where each fund manager from a style point of view can be slotted. Okay. It's extremely important for us to understand that, because it helps us understand the process of the fund manager. Because, most investors, what they see is the outcome, right? When you look at 1 year, 2 year, 3 year returns, it doesn't tell you much other than the fact that how the fund manager has done in the last 1 to 3 years. And there is a very interesting study that we've done. We can send it across to you in case you haven't got it. Is most of the fund managers who do extremely well on a 3 year basis, the next 3 years, most of them fall out from the top quartile of performance, right? In fact, 70% of them or 2/3 of them go to quartile 2, 3, 4, right? So just looking at last 3 year performance is a very bad strategy when it comes to allocating money to fund managers, right? So this 4C delves a little deeper. So clarity of philosophy is one. Then second is consistency. So we try to look for people who are consistent, right? Because when you see that a fund manager is consistent, and what do we look at consistency? 3 year rolling returns over long periods of time, over 10 years is what we look at. So if someone is consistent, even if he or she is going through a bad patch, right, you can be confident that they will come back. Okay, because styles keep varying. I mean, what market rewards from a style point of view keeps changing from time to time. Okay. Then third is capabilities of the team. Okay, what kind of team the fund manager has created, what kind of depth they have. And fourth is the class. When I say class, right, what is the experience the fund manager has? Like in sporting parlance, you say that form is temporary, class is permanent, right? So a good fund manager may be out of form, but he will come back. Okay, and we have multiple examples actually of fund managers who've done badly for 3-4 years and then come back very, very strongly. Okay, so 2 to 3 years back, we had clearly put out a note saying that, in this period of markets, we prefer fund managers who are more value oriented, okay, and who pick stocks basis, the relative cheapness, right? Because we believe the sectors that are likely to do well were in the portfolios of such fund managers. Right. And that has played out very well. And if you want, I can give you some examples like Prudential ICICI. Naren follows a value style of investing. Prashant Jain follows a value style of investing. And there are a few like Parag Parekh follows a value style of investing. So we had preferred those kind of fund managers, and those fund managers have done actually very well. Okay. But within a portfolio, when you're constructing a portfolio for the longer run, you need fund managers of different styles. Right. And I say that, if I have to give a very simple example, and sports is a very good way of explaining it. When you're constructing a team, right, you want good batsmen, you want all-rounders, and you want bowlers, right? So you will pick value managers and some growth managers who are well positioned for this cycle. Okay, so but we said I will have more preference towards value managers. It's like when you play a T20, you will prefer more all-rounders. Right. But when you play a test match, you'll make a very classic team. You will have good batsmen, you'll have good bowlers, and you'll construct a team from that point of view. Right. Then you'll make minor modifications depending on the pitch. If you're going to Australia, you'll take a fast bowler over a spinner, so on and so forth. So similarly, this period, we believe that the themes related to the investment cycle, manufacturing, engineering, power, road infrastructure, a lot of these themes are doing extremely well. And typically all these themes were, value picks 2 to 3 years back. But now obviously all of them
Correct. Yeah, which is what I was
have become growth
you.
sectors.
Yeah.
So I think, at the margin, we are now neutral towards growth or value managers. I think you need to have a bit of both in the portfolio. So hope that explains the framework and how we approach this entire.
Okay, so you're saying today you're having a blend of growth and value. That's how you're approaching.
Yes. 2-3 years back, when we put out a view, we said that we would have more value kind of managers. But now, these sectors which were value picks are no longer value picks. I mean, the prices have gone up, and they are also now, growth oriented.
Right. Okay. So we did have a chat about the earnings earlier. So if you see in the last, at least I think the March quarter was slightly better, but the other 3 quarters of FY24, we did see a very high profit growth coming from margin expansions, and the top line growth for India Inc. wasn't great. I feel this margin benefit has played out entirely in FY24, and how is it going to be like? Do you expect margins to still support the bottom line, or you think it's time for top line growth to drive the earnings?
See, that's where, I mentioned it at the beginning, that a lot of one-off gains have been achieved when it comes to corporate profits. And that's why we are saying that corporate profit growth will probably be a little more muted compared to the last 3-4 years. So a lot of the margin gains have been achieved. From now on, what could drive margin gains is operating leverage. See, a lot of sectors are going into the capex mode because capacity utilization is pretty good for them. So now, once the capacities come up and they start getting utilized, you would see margin expansion, right? Otherwise, next year I would not bet on margin expansion, to be very honest.
Okay.
Uh, Volumes have to drive, and that's where the sectors that I spoke where we are bullish. Those are the sectors where we are seeing growth in earnings, growth in volumes, growth in sales. I think one sector where I think you also pointed out, alluded to the K-shaped recovery, right? Which is a reality. I mean, if you look at consumer has been a little lackluster this year, right? And even there is a divide. If you look at luxury cars, if you look at real estate homes, if you look at high-end goods, right? There you see a rush, like airlines, you don't get tickets. Oh, luxury hotels, all of them full. Realizations have also gone up, right? But same time, if you look at HUL, if you look at new Nestle, if you look at till some time back, even two-wheelers. Two-wheelers, of course, in the last 2-3 months, you've seen pick up in volumes, but also that could be attributed to low base. But so clearly the mid-income and maybe lower income is struggling, right? So there could be 2-3 reasons for it. One is inflation has hit them hard, right? Because if you look at inflation on a 3-year basis, and if you look at the absolute price increase in a lot of daily essential commodities, it's been very, very stiff, right? So I would argue that a lot of the wallet share in mid-income households is getting diverted to essential purchases, right? And so that's why you see premiumization not happening in a lot of the consumer products. Second, this is another way of looking at it. If you see, government is also doing capex, companies are also looking to do capex, households are also doing capex, right? So real estate is nothing but capex for a household. Okay, so EMI is also taking away a lot of the purchasing power. So, if I have to prioritize, right, let's say going on a holiday versus, let's say, buying a house, which means I need to budget for the EMIs, I think people are choosing for the latter, right? And to kind of compound the problem, EMIs have also gone up, interest rates have gone up, right? So that's the reason I think the mid-income, lower and mid-income household discretionary consumer purchases have been a little lackluster. But there, I think the only solution is time. Incomes have to catch up, right? So eventually they will catch up because it can't be that only manufacturing does well or capex related themes do well, because India is the ultimate consumption story. It's just that incomes, adjusted for inflation, have to catch up.
Okay. So we did see gold hitting new highs, equity markets also. So we haven't seen this too many times in the past, I feel. So why is this happening? What's driving gold alongside markets currently?
I think we are in a very unique situation because what is happening is, whilst this year markets have started doing well globally, right? If you see the first 2 months, it's not just India. Last year, India stood out.
Yes.
Okay. But beginning this year, you've also seen global markets kind of rallying. Okay. And that's mainly because of US continuing to do well and certain parts of the world, beginning to recover. Having said that, a lot of the, previous decades expansion in global economy, US, has been driven by stimulus. A lot of it is monetary stimulus. And now, they're talking about fiscal stimulus in US, right? So clearly, whilst US has done well, there is also an underlying fear that they have printed too much currency, right? And a lot of the central governments have been diversifying their holdings from dollar to gold, because gold is considered a hedge against any how do I put it? Misallocation of funds by governments or profligacy of governments, right? So that's one of the reasons for gold to do well. The other asset class, which I mean, we don't have too much of knowledge on, but I'm just highlighting this because you should know, which is done very well is Bitcoin. Okay, both these are proxies to currency. Okay, so I think our view on gold continues to be positive, by the way, not just because of this currency fears, but if you look at the globe, right, there are geopolitical issues lurking and the background. They've not gone away. I mean, it's just that they've mellowed down, right? The situation is nowhere close to getting resolved, right? And then you always have this fear of China, Taiwan, right? And remember, this is a very election heavy year, right? This is the year, I think, where we're going to see a maximum number of elections. So gold will continue to do well. And we are also telling people that you should have some gold in the portfolio, according to me.
Like gold, there are also other alternative assets. I don't know whether gold is an alternative, but there are a few other alternative assets. Now, how are they correlated to equities? Are you using them as diversifier for your clients?
Fixed income is a big, allocation in most ultra HNI portfolios or even in some HNI portfolios. So there, other than your plain vanilla fixed income products like mutual funds, which have bonds, or now hybrid funds are becoming popular because of the tax benefit. A lot of ultra HNIs are also investing very, very heavily in private credit funds. These are funds which do structured debt to corporates who would otherwise not get money from banks, not because the balance sheet is weak, because of the nature of structuring that you need to do, right? So those funds are seeing a lot of inflows, and those can add some extra return to the portfolio.
Okay.
And real estate funds, they're nothing but another form of structured debt. It's just that the lending is to the real estate industry or developers.
Okay. And cyclically, if you see, they do the same cycle as equities, or do they follow their own cycles? I mean, do they complement the equity cycle?
See, in a broad sense, they will, right? Because when markets are doing well, companies are doing well, debt also becomes attractive because you are more comfortable lending from a balance sheet point of view. But they can be more non-correlated than equities, right? Because even when equities don't do well, these products can continue to deliver regular returns.
Okay, sir.
So they are in a sense non-correlated to equities. They give you diversification. But gold is actually almost negatively correlated to equities. Right? But these are non-correlated. Then you have, within the equity space, as your portfolio size goes up, you can do things like private equity, venture capital, right? These are a little more non-correlated to public equities. In a sense, ultimately, the valuation depends on public markets, but they have longer cycles. So it may not necessarily be that correlated to equity markets. Because if you have 10 private companies, unlisted companies in your portfolio, if those companies do well, then eventually you'll get a good return and you'll exit. The correlation to the broader market is low.
So one last question. So since you deal with a lot of HNIs, ultra HNIs for your clients, now how their risk return perceptions, how different is it vis-a-vis a retail investor? Are they willing to go big on the segments that you just spoke about? Or
yeah, so look, actually it's a little complex question, but I'll try to answer it. See the primary retail difference between, let's say, when you say retail, you're talking about investors with smaller portfolios.
Right.
No, I'm saying smaller portfolios and larger portfolios, right? So the primary difference here is that the larger portfolio clients, right, or ultra HNIs, however we may classify it, have already created wealth. So many of them are in a wealth preservation mode. Okay. Whereas the relatively smaller wealth portfolio clients, they're actually looking to create wealth for meeting a lot of the goals in their lives. Right? So they have no choice but to be more aggressive. Okay, so the allocation to equities or through SIPs, mutual funds will be much higher. Whereas, in the ultra HNI portfolios, you'll have more debt allocation, more real estate allocation. Plus, just because of sheer ticket size, there are a lot of alternative products that they can take exposure to, which at a smaller size you cannot. Because let's say an AIF. Now, the minimums in alternative investment funds is 1 crore. But many AIFs, which are Cat 2 in nature, they do not take minimums of less than 5 crores. So then, unless you have a 100 crore portfolio, 50 crore portfolio, you can't allocate to some of these products. So that is where they are different. And I think a lot of the larger client portfolios where they've been running these portfolios for a while have become more mature over time because of access to wealth managers, experiences, exposure. Right. So they're more mature from an asset allocation point of view. They respect asset allocation, may not get swayed to themes. Whereas, in smaller investors, retail investors who are coming to markets are fresh, you tend to see more risk being taken. You tend to see more, the more mature risk understanding framework probably is lacking, but, they develop it over time.
Okay, sir. Thank you. Thanks a lot for your time, sir. That was a very
Pleasure is all mine.
Will benefit from this, sir. Thank you very much. Yeah.
Thank you. Thank you, Vardhini.
Okay.